Bloomberg Audio Studios. Podcasts, radio, news.
I'm very pleased to say joining us now is Robert Kaplan, Vice Chairman at Goldman Sachs, previously, of course, served as the President of the Federal Reserve Bank of Dallas. Robert, very nice to have you with us. Thank you so much for coming in. So let's talk about the here and now in the U.S. economy and what you see. Weakening in the labour market. Is it right that the Fed should focus on the weakness in the labour market right now?
There's no question that labor market is weaker and very sluggish. There's three reasons why. One, tariffs, at least in the short run, are slowing growth in the United States, and they're affecting small business disproportionately. And you saw in this recent job weakness, a lot of the weakness was in small business. That makes sense. Second, there's been constraints on labor force growth, which reduces supply, but also there's a multiplier effect when jobs go unfilled. It creates other jobs that would have been created. You know, there's another half a job that would be created for every job goes unfilled. And then the shutdown has been a headwind for growth. So it's not surprising you're seeing some weakness. The trick for the Fed is as you head into 26, we've got a few tailwinds that may come to the fore. Tax incentives, tax on tips, tax on overtime, accelerated depreciation, regulatory relief, getting further along, and then still the AI data center power boom, I think, is underway. So that's why they're balancing what's the here and now versus the headwinds likely in 26.
And of course, there's a lot of focus on who's going to lead the Fed and who is going to be leading those conversations about the balance between inflation risks and joblessness risks in the United States. What's your thinking on the extent to which the market is concerned about the person themselves? I mean, this is in the end setting policy as a group activity, but the chair clearly has a big voice at the table. What should we know about the way these decisions are made and how much it matters who leads?
So the Fed is focused on full employment and meeting a 2% inflation target. And the reason they're sticking with the 2% inflation target is there's still 85 million workers in the United States that make 50 or 55 grand a year who are struggling to make ends meet. So affordability is a big issue in the U.S. I think any of the candidates mentioned have the intellectual capability and leadership capability to balance those issues. I think whoever's in the job, and I won't go through individual names, they will need to show that while they may be from the administration or other sources, they're going to be intellectually willing to balance those issues and have that debate without regard to political pressure or political considerations. And that's, I think, what the market wants to see.
Yes. I mean, how nervous are you about political pressure to get rates lower in the United States? Is this something that should preoccupy market participants?
Well, it is natural for administrations to want lower rates. Lower rates mean higher real GDP growth, higher nominal growth. But that's why the Fed is a little bit, has to be independent and when necessary push against that. So I think any of the candidates have the capability of doing it. And my advice to any candidate would be if you're in the job, you want to reiterate that you're going to respect and try to preserve the independence of the Fed, at least on setting the Fed funds rate.
If the White House, if the Fed wants lower interest rates in the States, and if that's what they deliver, if the market then worries about inflation, does that mean that the lower rates the Fed sets don't necessarily get passed on to the real economy? So could lower rates actually be self-defeating? So
the Fed only controls the front end of the curve. And so what you've seen, the Fed has cut 150 basis points since September of 24. The 10-year has hardly budged. Okay, it's down just a touch. And so the curve has gotten steeper. So, the market sets rates along the curve, and the further out the curve, the more their market determined. And so the Fed's got to be aware that has to have credibility for its actions.
And are you concerned about overheating at all in the U.S. economy around the AI theme? Is that you talked about how that there are going to be some tailwinds around fiscal stimulus in the States, tax cuts, also the AI build out?
There is going to be a firming, we believe, at Goldman Sachs. We believe that in 26, GDP growth is likely to firm. I think there's clearly enormous infrastructure spending for AI, data centers, power. We're in the early stages of AI adoption. I think there's a lot of worry, gee, is the AI infrastructure build overdone? I don't think it's overdone yet. We'll get to the point where we will think it's overdone, but we're in the early stage of downstream adoption. And so I think we see firming growth. I don't see an overheating, but when you have firming growth, you got to be worried inflation is running 2 3/4, 3%.
Yes.
And so the Fed just got to be very mindful of that.
And at the cold face of the sort of news flow around corporate adoption of AI, we get drip-fed little nuggets of information about these businesses adopting quickly. Here, there's some pushback. What's your big picture expectation about how quickly this can change the productivity narrative for the U.S. economy?
When we're sitting here talking 5 years from now, I would guess that you're going to see productivity growth in the United States and globally, but let's take the United States as that could be a 0.5 percentage point, we believe, higher. Corporate margins could be better. That's on the one hand. On the other hand, businesses are more likely to get disrupted. They've got to spend on AI in the short run. That may come out of margin. Over the long run, I think businesses who do it well are going to be more productive. So I think we're going to see the benefits. The surprise is going to be which use cases work and which use cases we thought would work but don't. And how does it affect industry and how does it affect labor?
Yes.
And so we're early in that workers are going to get disrupted out of functions, out of companies. They're going to have to move to other functions and companies. This is where early childhood literacy, secondary education, skills training, and adaptability of the labor force is going to get more important, and successful countries will invest in that.
So labor markets will need to adapt, and policy. What should policymakers, I suppose, keep in mind when it comes to labor markets and how quickly we might see the effects of AI on redundancies?
I think the thing about AI, unlike other technological and other structural changes, is how fast it's going to happen. So policies need to be, makers need to be aware. You're going to have mismatches. You're going to have lots of people looking for jobs. You know, computer programmers who used to have plentiful jobs now will need to find other types of work, but there's lots of open jobs also. Window installers, automotive technicians, electricians, and we've got mismatches. I would guess in the next 2 or 3 years, you'll see that continue. Those will get solved with the passage of time, but I think we're going to help people make the adjustment. So there's cyclical issues where lack of demand creates labor slowing, and then these structural mismatches. I think we're going to see more structural mismatches, maybe even if cyclically we're firming.
And on that structural story, is it your sense then that the negatives kick in more quickly than the positives? So the job cuts come and then the productivity gains come later?
I think human beings sometimes takes them a while to change their aspirations, change their job goals, and I think this is where we have to do a better job educating workers, helping them adjust, making that transition. But AI is happening so fast that the workforce may lag adopting, and also worker mobility, geographic mobility is probably historically low right now. You know, the house situation, you have already own your home, fixed rate mortgage. We're going to have to help people adjust. Okay,
Robert, thank you very much. Thanks for joining us. Rob Kaplan, Vice Chairman of Goldman Sachs and previously, of course, of the Dallas Fed. Our thanks to Rob for joining us. Really great to get his perspective on the AI up and downsides for the US economy and the Fed conversation, of course.